Hi there traders, in this short video we will have a look at one of the most important inflation indicator, which is CPI. CPI stands for Consumer Price Index. Besides other economic indicators such as GDP, trade balance, retail sales or manufacturing production, which are all growth indicators of an economy, CPI and other inflation indicators are used to gauge the level of price stability within an economy. The inflation indicators are extremely important to monitor as they are also on the radar of most central banks, as it serves them to determine their inflation target, interest rates and further monetary policy. There are more types of inflation indicators such as CPI, which is Consumer Price Index, PPI, which stands for Producers Price Index, CRB Index for futures, or PCE, which is Personal Consumption Expenditures Price Index. CPI, however, is the most watched and most relevant inflation indicator among all of these. That's why it's also marked as a red event on Forex Factory calendar, as it is often a very significant market mover. A consumer price index is a measure of the average price of consumer goods and services purchased by households within an economy. It measures the average change in price paid for a constant basket of goods and services from one period to the next. CPI is compiled from a sample of prices for food, housing, fuel, clothing, transportation and medical services. The percentage change in a CPI reading measures the price growth and changes in the cost of living. Rapid increase in the CPI value indicates inflation, whereas a rapid decrease can suggest a deflation. In case of deflation, the prices of goods and services decline and it indicates that there is no growth within an economy. For some countries, the core CPI figure is more important than the headline CPI. Core CPI excludes certain components which are most volatile or seasonally sensitive for price development. For example, in the United States, core CPI excludes food and energy, while in Australia, the core CPI reads as trimmed mean CPI, as it includes whole 30% of most volatile items. From the market moving perspective, the CPI release tends to create most volatility in the currencies of countries which release their CPI figures on a quarterly basis, such as Australia or New Zealand. Most economies, however, release their CPI every month. This includes Canada, USA or United Kingdom. In case of Eurozone, the inflation is derived from the readings of individual countries and in the form of final CPI, which is compared with the previous year's figures. The Eurozone release tends to have a relatively mild impact in the financial markets, as the CPI flash estimate and German prelim CPI figures are released about 15 days earlier. In cases of most major economies, sudden or unpredicted changes of the CPI figures lead to sharp increases in currency market volatility as traders and investors react in anticipation of move by a central bank to keep inflation under control. An interesting site to check the current inflation rates of many economies is Trading Economics, where you can compare a list of countries and their current economic situation. On this site, you can just click on the inflation rate and the countries will be sorted from the highest rate to the lowest. This nice comparison can tell you about price disbalances and countries where they experience deflation or hyperinflation. Let's switch back to Forex Factory. And on the last note, please bear in mind that any significant deviation in current reading compared to the expected figures and also compared to the previous print, including correction, can have a significant market moving potential. There is an increased volatility and low liquidity in the markets on the targeted currencies during these scheduled releases. It is therefore highly advisable to be very cautious while trading and to have a proper plan and a maximum control of your positions. That's about it for now. Thanks for your attention and remember to trade safe. Cheers.
you.